It's a wonky, wild world when you compare the bank failure rates to the assets under duress ratio. It's pretty shocking, like something you've probably never seen before, but I'm going to show it to you right now.
This is The Rare Advisor, proud to be a part of the Advisor Advancement Network and home of a business model supercharged by recurring and repeatable events. Your host is Mike Walters, CEO of USA Financial. He is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor.
Some people are freaking out about the mid-sized bank crisis as it's being referred to. And other people are like, well, what's the worries? It's really only 3 banks. I mean, think back to the financial crisis and what we were dealing with then. Well, candidly, they're both right. So what I'm sharing with you today are 2 different charts that help bring that into perspective and give you a little bit of an insider scoop view of really where this stuff kind of shakes out numerically. So this particular chart is showing you total assets and total bank failures. The green is total assets, which was capping out here at 400,000 millions right there. And then the number of bank failures capped out at a high of 157 in terms of its annual numeric. And then you see it all kind of drop back down. So it was kind of running normal before that, spikes up, right? And now it's dropping back down. And then all of a sudden, look at this green line jump up here. Now we're at 548,500 millions. It's an easier, seems like there'd be an easier way to say that, but you get the idea. Millions, but the flip side is down here, we're only looking at 3 banks. So on the one hand, it was just 3 banks. On the other hand, it was more assets than was under duress during the financial crisis. Now, this is actual straight line numerics, but even if you put an inflation trigger in there, you're still seeing a pretty significant jump in what's happening. Now, this is one way to view it, so you see it in lines. What I want to show you next is a gentleman created these bubble charts where the bubble is the size of the bank, and then in terms of its assets, and then the number of bubbles, as you can see here. So very similar. Here's this big jump up, just like we saw on the other chart, and then it runs back down. And then as you can see, look at all these, these hundreds of banks in here. But really, the big boy was Washington Mutual. All the rest of them were quite a bit smaller. And then we come out to what's taking place here. So this was that jump on the assets, but there's only 3 banks: Signature, Silicon Valley Bank, and First Republic Bank. So again, it's only 3 banks. They weren't, the huge players in the market, but numerically, in comparison to previous bank failures, they were pretty significant. So the number of banks is pretty low at 3. Hopefully that doesn't catch and start running amok with more banks, but the number of assets was higher than probably you would have guessed.
This information is for licensed financial professionals only and is not intended for use in soliciting sales from the public. The views expressed represent the opinions of the presenter or their featured guest, not necessarily those of USA Financial or its affiliated subsidiaries. Industry references are generic and not intended to represent actions or beliefs of any individual or entity. Content is only presented to illustrate general principles, beliefs, or ideas and should not be construed as legal or regulatory advice. Trademark and copyright protected. USA Financial and Affiliates.